Okay, everyone, thanks for joining me and thanks for having me again, David. It's always a pleasure to participate in these events. It's always fun to listen in on all the other presenters as well. So we're going to talk about automatically trading option spreads. We've got a proprietary solution that we've developed, and these are the same types of strategies that professional options traders are using. We don't have to watch our screens all day, and we're going to use some automation to help us along the way. Remember, we are speculating and we're always accepting risk when we try to generate a profit. And with that said, do take a moment and look at the risk disclosure. It's important to note that all your trading funds should be risk capital and that past performance is no guarantee of future results. And a little bit about AltaVest. We are a introducing brokerage firm. We're registered with the CFTC. We've been in business since 1997, and we've traded millions and millions of contracts along the way. That's yours truly there, surrounded with some of our colleagues on the trading floor. That's the S&P 500 futures options pit in Chicago. Those were our floor brokers that worked with us on a team, filling all of our orders for many, many years. Of course, it doesn't look quite like that any longer. Most everything is now moved to the electronic space, and we'll talk a little bit about that. But a little bit more about us. We created the Dragonfly option strategy as well as our proprietary order technology. Again, trading millions of contracts with clients, and that's a picture I took on the trading floor. A little blurry, but I still kind of like it. And we're registered again with the CFTC, members with the NFA. We're located in California. And a little bit about yours truly. I was licensed back in 1991 with my Series 3, graduated from the University of Southern California with my degree in business, and started off in securities, Series 6 and 63 licenses. It's kind of doesn't mean a whole lot to probably most of you, but really what it means is mutual funds, annuities, that type of thing. And then I, of course, still have my Series 3 commodity futures license as well as my Series 65, and that's what investment advisors use. So with some of those preliminaries out of the way, let's jump into kind of the meat and potatoes here, and then we're going to run into a demo of our software solution. But this is feedback we've received from clients over the years, kind of the top 3 barriers for all of us. And one is really noise. You have conflicting targets and opinions, lots of choices. Here's an options matrix. You can just one strike price, or I'm sorry, one expiration for one market. Here's all the strikes and your puts and your calls, and it's difficult to know exactly where to start and where to end. Then you have price predictions. Of course, this one kind of cracked me up. It's from last year or the end of 2022, and I've left it in there. Bitcoin's either going to $250,000 or $5,000 in next year. Of course, it didn't get either place, but what are you supposed to do with that information? And here's price targets, all the big banks, and this is just from a few months ago, and they update their yearly price targets and whatnot. But you can see this array of opinion, and again, I don't know. I think it's kind of a bit of a joke, really. It's no help at all. And what does year end have to do with anything? It's just an arbitrary date. It has nothing to do with market cycles or anything. So it's just clickbait, really. Okay, how about time? That's the other discipline. Do we really have time to screen watch all day, or at least the bulk of the day? Not many of us do. And this is a wise bit of wisdom here from Tolkien here. All we have to decide is what to do with the time that is given to us. So a lot of things we can do with our time during the day. And I think some of us would rather be doing other things than being glued to a screen. And how about just ourselves? We get in the way of our own success at times because we're humans and we have emotion, fear and greed, the two that really are the enemies of traders. We tend to ride this emotional roller coaster ride as we're trading. As you're, sometimes making money, you can get euphoric. Losing money, you start to wave that white flag of surrender and capitulate, and you get depressed, and then maybe things turn around for a bit, and you get optimistic again, and you kind of just ride that same roller coaster. So hopefully we can help you control those emotions. That's part of really a big reason why we created what we did, and we're going to show you in just a second. And we're going to look at how we can trade options like some of the large institutions are doing it. And for example, an insurance company is a large institution, and what's their business model? Well, let's see if we can emulate what they do with options. And just to review what insurance companies do, they get paid premiums to assume risk, and they sell and manage time. They're always insured by hedging. They're consistent and they're patient in their process. They look at mathematical probabilities and favorable long-term odds, statistics, actuarial tables, that kind of thing. So that's what they're looking at. And maybe we can collect premium as well when we're trading options. We'll look at premium collection strategies, and a lot of these are base hits is what we call them, not grand slams. By going short options, we can be consistent and patient in our approach. Of course, we'll manage risk because we will have losing trades, no doubt about that. But just as importantly, manage reward. You don't want to get greedy and overstay your welcome. And then we're going to show you how we can help you with experienced coaches along the way, and of course, using the proper tools. Again, not swinging for the fences, no grand slams with selling premium. So these are short option strategies, and they can be non-directional or bullish or bearish. And some of you might be scratching your head about non-directional strategies. You know, how can you intend to profit on a trade if the market's going sideways? So we're going to show you that. So we're going to look at targeted outcomes with a fixed risk. These are called credit spreads, where you collect premium, your positions are insured, predetermined risk and reward, and of course, non-directional. I already mentioned that. Before we jump into that, we're going to look at two of the Greeks. It's just options terminology here. We're not going to get into the weeds. It's real simple, but these two are important here. Delta, it's how much does the option value change with the change in the underlying asset. So that's what it means. And traders look at it like the approximate probability of the option expiring in the money. So for example, if an option has a delta of 0.25, there's a 25% chance that it expires in the money, but the inverse of that is a 75% chance it expires worthless. So delta is always moving with price and time, and of course with the underlying asset as well. So it's a moving target, so to speak, and it is not the probability of a winning trade. So don't make the mistake of thinking that. And then there's theta, and theta is really just a function of time decay when you're looking at options. It's an option is a wasting asset and it has a limited lifespan. It will expire at some point. So theta is a negative number. It equals 1 day of time decay. So if a premium is 10 points and theta is negative 0.05, the next day after that, the premium is 9.95, and then it drops to 9.90, and so on and so forth. Just the theta element, of course. And this is what it might look like on a graph. So here's the value of the option. So the value of the option drops and drops and drops as you get closer to time zero, at least the time value, I should say. All right, so Wall Street pros, how do they do it? Well, they often trade multi-leg option spreads, and they collect premium. Here's this woman, we'll get to her later with a link if you want to look up the full video, but she says an option spread is buying and selling different contracts, very common way for investors to hedge risk and volatility. And it's usually cheaper because you can offset your cost by the proceeds from different contracts. And she's absolutely correct. And it's been used by Wall Street professionals for decades. So we're going to dive into that here in just a few minutes. And then we mentioned emotion, but how can we, with our emotions, compete with the algos? So systematic trading, high frequency trading, machine trading, that's what we're talking about. This is your competition. They just run on no emotion and automation and built-in risk and reward controls. In fact, JP Morgan estimates systematic trading represents 90% of US equity trading volume. So people like us sitting behind a screen every now and then placing a trade, that is not your competition. It is this here, the machine. So how can we use algos for professional style options spreads, the type of strategies that Wall Street is using? Well, we can use automation to collect premium. We're going to look at some unique bearish, bullish, and non-directional approaches. A couple examples first before we get into the software. So here's selling an E-mini S&P 500 call spread. So this is something you would do if you're bearish or moderately bullish, or even if you expect a choppy market. So here's what it might look like. Here's a graph, and here's the price at the time you might place this trade, and you sell this 49.10 call, and you collect 4.5 points. You put that in your pocket, but simultaneously you buy a 49.30 call, and that cost you 2.25. But the net result is you collect 2.25 points, $112.50, because it's $50 a point, minus your commissions, of course. And so that's the idea of selling a call spread and collecting the net premium for doing so. And you can see the market here rallied and ran higher and went lower and started to move higher again, but it stayed below your threshold of those short calls. And then here's an example of a put spread. So you would do this if you're bullish or moderately bearish or non-directional. And again, I think the graph kind of helps. So essentially you're selling this put spread below the market, and you're collecting a net premium. You're putting that money in your pocket, and your intent is, your hope is that the market just kind of chops around, moves higher, or even, slowly drifts a little bit lower. That would be fine too. And we'll show you more about how this all works in the demo. These are not naked options, okay? So if you're trading naked options, or someone wants you to trade naked options, I wouldn't do it. You're going to make a lot of money until you don't, and you're going to end up on margin call. That's one thing I can guarantee. So no naked trading, and we want to use covered spreads, covered strategies. Your maximum risk is capped in advance. And again, no margin calls and no unlimited risk. That's the big advantage of trading covered spreads. Thought this was a good one here, so I put a little bit of levity in the presentation. This woman here sees a margin call on the phone. I guess it's his phone, and she says, "Who is margin, and why does she keep calling you?" So yeah, avoid those margin calls, folks. So here's an iron condor. It's a combination of the put and the call spread that we just saw. If you're not familiar with this term and what it means, it's just that simple. You're selling a put spread and call spread simultaneously. And here's what it looks like on a graph. So this red arrow is the option you're selling, in this case a 49.40 call, and you're buying a 49.60 call simultaneously as a hedge. And then same thing with the puts. You sell a put, buy a put to hedge it, and you collect net premium. That's the net result. So you're looking for the market to stay within this range. So for every short option, there's a long option. That's what we mean by covered. And a short iron condor spread has a non-directional bias. And so why is that worthwhile? Why would you even consider that? Well, because of theta decay. We looked at the theta decay and how that works. So hopefully when you place that spread and over time, the value of that spread is now lower, where you can buy it back for less than what you received. So here's an example. That spread we just looked at, you sold this call spread, you sold this put spread, put the money in your pocket, market starts trading, and you get a signal here to close out that position and take your profits. So you sell high and you buy low. That's the whole idea here. And I'll show you what this all means here in just a second in our demo. And then here's the proprietary dragonfly. Some people say that's really weird, but that's a bit of a, I guess you say, a compliment. So that's the strategy that we developed years ago. It has 6 legs to it, and it's a variation on the condor, and it's non-directional in nature, just like a condor. And here's what it looks like on a graph. So you sell 4 out of the money calls, you buy 3 higher strike price calls and 1 closer to the money call. Then you have the same structure on the bottom. You sell 4 puts, you buy 3 further out and 1 closer to the money. The net result is you collect premium from selling these puts and calls. And let's look at how this might play out here. So again, the idea is that theta decay will come into play and reduces the value of that spread, and then you can buy it back for less than what you originally received for it. So you can see here in this example, market kind of starts going sideways here, chops around, and after a period of time, you get a signal here and it says, take your profits, buy the spread back, and move on to another trade. So that's kind of what that looks like. We're going to show you in more detail. And of course, there are strategies for being bullish and bearish as well. It's just not non-directional. So options are very flexible. But here's the question you probably have is, I think that's Jackie Chan, isn't it? So there's so many choices when it comes to options. Where do you even start? You know, which markets to choose? Are you going to be short? You're going to be long? What's your pricing? What's your timing on your entry? You know, how do you manage the risk and the profit? So there's a lot to think about, and that's why we created ThetaTrader. That's our proprietary solution. And these are pre-built option spreads with our proprietary algorithm generating what we call theta trades each day. And these are professional strategies, the type that we just talked about for any market condition. And then we have automation to help with the risk and the profit tracking, something called the RTI, or the risk thermal indicator. That's our proprietary indicator. So we're going to jump into a demo. I'm going to have to switch screens on you, so give me just a moment. Okay, so you should be seeing my ThetaTrader dashboard right now. And if you can't, I guess you'll let me know. So I'll just assume you can. It's kind of the little bit of a flaw, I think, with Zoom. You can't always see what screen you're presenting. So anyway, this is ThetaTrader, and this is the home page, let's say, your dashboard. It's the demo account. Your page would look a little different, but for all intents and purposes, very much the same. So you can see Theta Trades up here. You can see your open short or sold positions here, open bought positions. And then over here is your account info. This is integrated with your trading account with AltaVest. And this is an AltaVest solution or product. So this is our software that we created for our clients. So you have an AltaVest trading account to use ThetaTrader. And then here's your current quotes up here. So again, this is just a demo account. And I just randomly pick trades during webinars like this. So don't make too much out of what all this means, but I will explain it here. And you'll see there are bullish strategies that are pre-populated. Of course, bearish and non-directional or neutral. And you'll see that, I think you can see those pop-ups or maybe not, but the ES is the E-mini S&P 500. NQ is the E-mini NASDAQ 100 and the Russell E-mini 2000. And I'll tell you why in a bit more detail, why we look at the E-minis, but in a nutshell, that's where the volume and liquidity is, and that's your best execution. It's just that simple. So why don't we first look at some of the theta trades for today we looked at condors and dragonflies. So why don't we focus on a condor? And you'll see the algorithm has chosen these theta trades for today, all on different expirations on the E-mini S&P 500, anywhere from 17 days till 59 days till expiration. The strike prices are already pre-selected. And then this is your profit potential at expiration. And this is something called the targeted annualized return. And I would just note that this number is really to compare one trade to another. That's why it's there. It's not that you would expect to place this one trade every 17 days and by the end of the year make 177.86%. So just to kind of clarify why that number is there. And it makes sense that the targeted annualized return on a trade with less days till expiration would be greater because it just assumes you're just turning that trade over more times throughout the year. But anyway, we'll look at this April week 1 expiration. Let's drill down on that and look at the details. It's getting there, folks. It's just thinking. All right. First thing I like to do before we dig into the numbers, I look at a graph. So here's the market, and you're selling this out of the money call spread, and you're selling this out of the money put spread. So you can see the 46.30 puts are the ones you're selling, and the 53.60 calls are the ones you're selling. So you see this wide margin of error between the calls you're selling and the puts you're selling compared to where the market is right now. And you'll notice here, we'll look at this briefly here. Here's the expiration date, 59 days till expiration, settlement value, net premium, put risk, call risk, commission, capital, cash required. Well, this is a important one here. So the cash required really is the maximum risk. It's in this case, the maximum risk is your put or your call risk. In this case, the put risk and the call risk are the same, minus the premium that you're collecting, of course, accounting for the commissions as well. But so it takes about $900 to place the trade, and your maximum profit potential is $84. And here's the question people ask: is that seems like it's skewed the wrong way. I'm risking a lot more. You know, it's like 10 to 1 almost in terms of how much I can possibly make. Well, the difference is the probability of this occurring is in your favor, because the puts you're selling have a delta of 9.98%. So that means there's over a 90% probability that these options you're selling would expire out of the money. And here's the delta of 6.66 on the calls you're selling. So again, over a 93% probability that these calls would expire out of the money as well. So that's the difference in the setup here. You're kind of turning the options trades upside down and trading them, you know, sort of like an insurance company might. Now, it always defaults to a sell when you're doing a condor, because you're selling the condor and collecting the premium. Always defaults to a quantity of 1, but we'll just, for the sake of the demo, we'll do 5 of these, and you can see the cash required and profit potential moves higher. We'll leave the value there at 210, and we'll go ahead here and just place that order. If it were real, then your order would be submitted, and if it were filled, it would show up here that it was filled. But of course, as a demo, it just assumes you're filled. So it's just that simple and that easy to look at a theta trade and then place that trade. And then I'll show you how everything gets tracked and monitored in just a second. But before I do, I want to show you a dragonfly. Okay, so we're gonna look at a dragonfly here, and we'll look at the April week 3 expiration. And this is again on the E-mini S&P 500. We could do a NASDAQ or Russell, but we'll go ahead and stick with the S&P. I'm just gonna point out the distinction or the difference between the condor and the dragonfly. And we'll look at a graph. And you can see here, you're selling these 4 calls, you're buying 3 further out and 1 closer to the money. So the one that you buy, in this case, is 50 points closer to the money compared to the 4 that you sold. And you have the same structure here on the bottom with the puts. Selling these 4 puts, and the one you buy is also 50 points closer to the money. So that creates additional level of insurance or an additional hedge on the position, but it does cost you a little bit of money. So it creates a slightly more risk averse trade compared to a condor. You give up a little profit potential, but it does have some advantages, and I will show you here, and we'll compare the dragonfly and the condor in just a second. But because you're selling 4 calls and 4 puts, your cash required, of course, is higher than a condor. In that example we looked at just a minute ago, we just did a trade of 1 call and 1 put. But you can see 4,686 cash required, profit potential 313.50, your targeted return on cash and your targeted annualized return. And this number will always be less than a condor. And again, that's because you pay money to buy this call and to buy this put. So that's additional insurance, and that costs some money. And we will go ahead and look at, again, the put and the call and the rest of these here that the algorithm has selected. You can see the delta below 10%, the delta here below 7%. So again, 90% and 93% probability that these options would expire out of the money. We'll do a quantity. How about we just do 2 of these? We'll leave that in around 8 points you're trying to collect. And there, it just assumes you're filled in the demo account. So it's just that easy to have a very otherwise complicated trade placed. And even more than that, we'll show you how to have that automatically managed and monitored on your behalf. And what I'm going to do here is notice here there's something called a simulator. So there's a back testing engine where you can back test these 4 and even 5 and 6-legged option spreads. I've never seen this before anywhere else. If it exists, someone tell me, but I've never seen it. But what I've done is instead of just spending the time loading the simulator, I've loaded a couple here for the sake of time. So here is a trade from December of last year. It's a condor, and you can use these buttons to go forward in time, backward in time. You can play it a day at a time. And you can see here that as we're going day by day, the trade, the P&L on the trade is now getting profitable because theta decay is starting to work. And this green RTI is the risk thermal indicator, and that means do nothing. The trade is maturing just fine. And then it turns blue, and blue means take profits. And when it turns blue, you can set up ThetaTrader so that it's automatically monitoring and scanning and watching. Whenever it turns blue, it will automatically submit an order for you to close out that position and take profits. So you can have this automated where you don't have to be responsible for placing that order to close out that trade. But ThetaTrader says, the algo says, this is enough of a win. It's enough of a victory. The trade has matured enough. Take your profits and move on to the next trade. And I would point out that we do not hold trades till expiration. So you can see that you're going to get a blue profit signal, or you're going to get an exit signal when it turns red for too much risk. And whichever occurs first, you're going to be out before expiration. So that's just an example there of a typical condor and what that might look like. Oh, I'm sorry, that was a put spread. But either way, that's just selling a put spread. But let me look at a couple other positions here. Just a second here. No, I thought I had this set up, but that's okay. Somehow I ended up looking at the same put spread over and over. But we'll look at it's a good opportunity to show you how this works anyway. Just going to go back in time. You can kind of get to see how this works. We're going to look at a condor and a dragon. Okay. Here we go. Into month expiration. I just kind of used the one with the most days till expiration. So here, we'll look at this condor. You can see it turns yellow. That means elevated risk. And you can see why. The market started dropping a little bit quickly here after you place that trade. Now it's getting green, and your P&L is now green. And then it turns blue, and there's your profit-taking signal. ThetaTrader says, get out. There's 16 days of time remaining. You've made enough money, and move on to the next position. So now let's keep this in mind. That was on August 1st, and that's the end of month expiration. Okay, and so let's go to August 1, and let's compare that to a dragonfly. So here's the same expiration and the same date, August 1st. Instead of a condor, we're going to do a dragonfly. Again, turns yellow, elevated risk, but still do nothing. And it turns blue on September 14th. Take profits, move on to the next trade. And if I recall, looking at this date, yeah, they'd also turned blue on the same date. So let's look at a different example here. Okay, let me see here. This is November 29. Okay, here's a good example. Here's a condor, November 29th. And you can see even more elevated risk. You can understand why. It's getting close to the upper boundary there. Then it turns back. And this one's really getting close to the edge, and then it turns red. So that's a losing trade. And when it turns red, you'll be able to, again, have ThetaTrader automatically monitor that and place that order for you. Now let's look at the dragonfly for that same date and same expiration. And look at that. It actually turned blue and gave you a profit-taking signal with 15 days till expiration. So I wanted to compare and give you that distinction where in this case, the dragonfly actually ended up being a winning trade compared to the equivalent condor. And that's because, again, you own this call option here, and it's gaining in value more rapidly than the further out of the money calls that you sold. And that's because, of course, it has a closer to the money and it has a higher delta, and theta decay won't impact it as much because it's closer to the money. So that's kind of the big I guess you could say a big advantage of the dragonfly is sometimes it'll have a winning trade compared to a condor, and even other times you'll be able to close a trade earlier compared to a condor. And let me look at one others. Let's see here. I want to look at one other. We've got some time. Yeah, let me show you that example. Comparing the condor to the dragonfly. We'll just go right to the end here. So you can see the the condor on August 11th had a profit-taking signal. So this trade worked out fine. So that's August 11. And let me do this here real quick. Let's open a new tab right there. Okay, we'll look at August 11 here, and we'll look at a dragonfly instead of the condor. We'll go right to the end and let's see what happens here. And look at that. This gave you an exit signal here on September 5. Oh, excuse me here, folks. So you can see how these, let's see, August 11. Oh, you know what it is? I picked a different week 4. That's why I picked a different expiration. But anyway, my mistake there. But you get the idea how the dragonfly can be more robust compared to the condor at times. It can sometimes get out earlier, or it can sometimes actually generate a profit when a condor takes a loss. So that was really kind of the distinction I wanted to make there. And let me jump back here as well. Let me show you one other item here on these simulations. You can go backwards in time, and just a second here. And it's more than just the condor and the dragonfly. I just want to point out, you can go backwards in time and look at any bearish strategy or any bullish position on the mini family, so the NASDAQ, the Russell, and the E-mini S&P 500. So that's how the simulator works. It's a great tool. It's actually a lot of fun to use. But I do want to point out here under the My Account setting, there's something called TradeScope. We do a proprietary newsletter and our daily comments every day. So this is what can help inform you in terms of what's happening in the landscape with the trading environment. So I was looking at some technicals and some global macro data, and then the daily trading summary gives you an outlook for, actually just really summarizes what's going on in Asia and Europe and the US, and then kind of looking ahead with any thoughts and comments on what to look for in the near future, and then an economic calendar. So that's a very helpful bit of information there for clients. Now here's really kind of the secret sauce. So you go to settings, and this is what you do here to activate the risk manager, and that automates it, and it activates your profit directive. And then you just save the settings, and that's all you have to do, so that when you have any trades on, we'll go back to the dashboard, whenever they turn red or blue, whichever comes first, ThetaTrader will automatically place that order for you and close out that position for you. And then you can also look at, your everything on your dashboard here, your open short positions, your open bought positions. And just for kicks, let's just go ahead and, instead of just doing a dragonfly and a condor, let's assume you're bullish on the NASDAQ. And here's a trade, we kind of came up with a term for it. We call it a bull hedge. It's essentially you're long a call spread, and to pay for it, you sell an out of the money put spread. So let's take a look at that just for a second. I'm going to increase the size of the screen. Hopefully you can see it better now. So here's what this trade looks like. You buy this out of the money call spread, and to pay for it, you sell an out of the money put spread. So that finances it. You can often do this for even money or not a whole lot of money, or sometimes a credit. It just depends. And then you would just place the order. It's just that simple. So just kind of pointing out that you can do other things rather than just being non-directional in nature. And then I also want to point out one other thing here as well. And then we're going to jump into, I think is probably the best feature of all. And if you want to be even more basic than that, you can actually, if you're bearish, for example, I click the bearish tab, you could simply just buy some outright puts on the index. You could sell an out of the money call spread. You could buy a put spread, and you can even buy a condor. You don't always have to sell a condor. It's not a high probability outcome, but it's something you can certainly do. Here's the Russell. Russell's been struggling lately, and in this case, maybe you want to go ahead and just buy a put spread on the E-mini Russell 2000, and you can do that as well. So just want to point out that ThetaTrader is an all-encompassing tool that was really designed to make options spread easier, and you can really use it in any way you'd like. But I think it helps to sometimes look at how you can sell options and take that higher probability outcome and put it on your side. And that's what we like to do with ThetaTrader. And then this is also a feature trade builder. Sometimes people will say, well, I want to just start fresh and build my own trade. So you can do that here, picking your expirations, your market, your strategy, and then you just go ahead and go to the next page and build that trade any way you like it. So there is a trade builder, and you can also modify any one of these theta trades if you'd like. Most people don't, some people do, and some people use the trade builder as well. Just kind of start with a clean slate and build their own trade the way they would like. But you certainly can modify any theta trade. You know, for example, if there were a condor and you wanted to alter the strike prices, you could, and it will recalculate that for you. And then also want to point out too that everything in ThetaTrader is calculated with the trading costs and commissions already factored. So everything, all the results, all the money, all the percentages are net of all trading costs. But you can change the strikes if you'd like. You can move them around, but you know, you will get some warnings at times if you move your strikes too far in any one direction. ThetaTrader will kind of give you a little pop-up warning saying, you know, this trade now has more risk or whatever it might be. But I did want to point that out. All right, so there's a good rundown. This is also helpful too, before I jump into the next segment here. This is a glossary, so you can see the color coding here for the RTI. We don't have to jump into that right now, but it's all there as to how it works. And then here's all the definitions on all the spreads if you need a primer on that. And then also, I want to point out we have a whole video series available here under education. So this is a whole video series for options and placing trades within ThetaTrader. So it's very helpful. It's all video, just short little 2-3 minute videos if you need some help. But ThetaTrader is very simple and very intuitive to use regardless. All right, now I want to jump into the very best feature of all. Give me just a second here. I've got to switch back. So this is our trade alert functionality within ThetaTrader. You'll receive these one-touch responsive trade alerts. You'll get these on your phone or in your dashboard. You'll get a graph, you'll get a description of the trade, and the quantities all pre-selected for you, and you simply touch accept or reject. So that's what it looks like. One-touch responsive alerts, very convenient. These are live and integrated with your account. So it's not an email, it's not just a text, it's already integrated. It's part of the trading ThetaTrader technology. So here's what it looks like. I had a newer video, but this work looks basically the same. We've added some new features, but so you'll have a graph, you'll have an explanation of the trade. I had a glitch on the newer one, so that's why I'm using this one. You can see it's pre-selected here. In this case, this demo selling 10 of these iron condor trades. Here's the premium that's being collected, the cash required. It's a little more clear there. You can see there's 71 days till expiration. And if you want to place that trade, you simply touch accept, and that's it. That's all you have to do. The technology handles the rest, so I'll play it one more time. It's really not complicated at all. So you'll get this on your smart device or via your dashboard. It'll show up, and you'll get an email, so you can respond with accept or reject. And it's just that simple. All right, folks, let me show you how you can get involved. We call it our ThetaTrader membership. That includes the ThetaTrader software that you just saw, which means you get all the theta trades, the risk thermal indicator with the automation for the risk and the profit taking. And then the trade simulator, you saw what a great tool that was to back test. So that software is valued over $3,500. And you also, of course, get those trade alerts that we just saw. And those trade alerts are integrated with your account, valued at over $4,400. And you'll be able to then have the RTI, the risk thermal indicator, that color coding management, basically initiated if you would like. And once that's done, those trades can be closed out for you. And there are adjustments and roles at times, and you can choose to accept those as well too. So that's how that works. ThetaTrader membership includes everything you just saw, and it also includes us. So we are here to be your private coach. You'll be able to do like a screen sharing session, and we'll be able to work with you. We're licensed, we're experienced. $7,500 value to have someone as your co-pilot, someone who's licensed. And, that's kind of invaluable. I know that systems sometimes cost $25,000, $50,000. Training courses, educational courses, I know cost sometimes $20,000, $25,000. And that's okay. But what we're saying is with ThetaTrader, we provide everything you need to use ThetaTrader and trade options with us. So you have everything there valued at over $15,500. And then, sounding a little corny, that extra bonus, as they say, we have that proprietary research I showed you, which is TradeScope and the daily trading summary. That's valued at over $2,900. And that's only for ThetaTrader clients. Of course, I mentioned those online video tutorials. So you have everything you saw in ThetaTrader, including the private coaching and the research, $18,500 value. And of course, that's not what we're going to charge. With webinars, we like to make these very, very approachable. We did used to do live in-person events before the pandemic, and our membership was $4,000. So we'd have people coming to the back of the room at the table signing up. But of course, again, we love doing this at a much better deal for you. So $597, and it's a 30-day money-back guarantee on that. So if you sign up and you change your mind within a month, let us know. We'll refund that membership. Here's the link, cf.altivest.com/TR. And that's my direct phone number. So maybe even take a screenshot or a picture of this page. Of course, that's my email. But it's just that simple, folks, just that one form at that link. And it does expire Friday. It's not kind of open-ended. And we like to keep the presentations fresh. That's really the reason for doing that. So a few FAQs. Tax efficiency, this is a big one, folks. If you're trading futures options like we are, you're tax efficient. Bet you may not have known that. You can lower your tax rate by over 10% because of the tax efficiency, how the IRS treats what they call 1256 contracts. Here's an example if you're trading individual stocks and stock options. In this example, you have a $7,400 tax liability, 12.6% return. If you're doing options with us, in that same example, you only have a $5,300 and $60 tax liability, 14.64%. The bottom line is you save over $2,000 in taxes simply because you're trading in a tax efficient space. It's not how it works with stock options. Yes, some stock index options, but not just individual stocks. So there's a dramatic difference in the tax efficiency, and you don't have to itemize as well. You just have a 1099 with your P&L, and that's it. That's all you need. And I should say this as a caveat, I am not a tax attorney or advisor, so always consult with your tax specialist on that. And a few more advantages to trading the E-minis. I mentioned large volume liquidity access. This is just from a couple months ago, but they had 1.6 million contracts per day trading on the equity index options, so the markets that we're trading. And that means you get superior execution, again, according to the CME group in an article, compared to SPX options. ES options offer a cost savings of $4 to $15 per contract. So what that means is you get tight bid offer spreads and execution. They talk about large market share, densely packed strikes, 100 annual expirations. So you noticed in ThetaTrader, all the different expirations available. So the algorithm was looking for the strikes it needed, and it could find them. So you get, your calls and your puts. As time goes by, you get another set of calls and puts to trade. Another expiration comes, another set of calls and puts, and so on. So the algo is looking and seeking and finding what it needs to build these trades. And here's a big example here in terms of a difference between this and trading in the stock market. You can't do a dragonfly in one order at one price. You have to leg in as two separate spreads at two separate prices. So this is really the only place you can do a dragonfly effectively. And so that's what, we can offer that immediate access to these sophisticated option strategies. According to that same woman at CNBC, I'll show you here, she talks about stock options traders, the retail stock options traders. They only have access to the most basic call and put options, at least most of them. And they don't have access to sophisticated spread or other more sophisticated strategies. She talks about how rookie trades options. The only time you buy stock options is when theta is working against you, if that's all you're doing. Let's look at what she says here. The appeal for retail investors to buy options is that they're much cheaper, but your potential for profit is actually not that high. In 2021, 11% of Robinhood active users made options trades, and fewer than 1% of that actually made a multi-leg option spread. So what she's saying is, yeah, you can buy a lot of options all the time, and the reason the probability is not that high is just because, by definition, your deltas are so low. So that's really that simple. And you want to trade option spreads for longevity. More advantages to trading these futures options on the E-minis. Again, you're trading indexes, so you don't have to follow 600 or I'm sorry, like 6,000 or 7,000 different security tickers. Efficient margin, and then a clear cost structure. We talked about that a bit. And remember, these are not securities options. These are all Globex traded. That means that the CME Group, if you don't know what that is the largest futures exchange in the world. Everything trades electronically through Globex. That's their system. That means every order, whether it's one lot or a 1,000 lot order, every order is getting equal treatment. There's no hidden cost for free stock trading or payment for order flow. None of that ridiculous nonsense. There's nothing like commission free. Robinhood and others say they're commission free. It just means your orders get executed at worse prices. So you're paying for it. So that's called payment for order flow. None of that exists with AltaVest. Our commissions are 5.25 round turn. That's all in. Here's an example of a brokerage. They trade stock as well, big box brokerage. They say their rate's 2.25, but that's only one side. That's not round turn, and then they charge you more clearing and exchange fees on top of it, and it ends up being more. So our rates are competitive. Again, everything's net of all trading costs. Everyone's performance is different, of course, because it's a brokerage service. Everyone makes their own decisions. What size of an account? Well, we suggest 25,000 as a minimum. Each dragonfly is about $5,000. So that's why we suggest that. Now, if you want a free membership, we'll gladly do that. $100,000 or more in your account, we'll give you a 100% rebate. $50,000 and above, and you get a 50% rebate. We're glad to do that. People like taking us up on that offer all the time. And I see some questions coming in. I'll get to those in just a second. Any type of account, we can work with you on that. And why would you even consider something like ThetaTrader? Well, it's really an alternative approach. It's an absolute return approach, really, when you're doing these kind of option spreads where you're collecting premium. So it may improve diversification and lower portfolio risk when you have exposure to alternatives. But really, what's the risk? Risk of what? Well, the Fed is still way above their inflation target. 2-year meat inflation is almost 100% higher. This is all kind of some anecdotal stuff, but it's kind of fun to look at. But this is not so anecdotal. Long-term inflation is 4 to 5% each year. Everything doubles in price 14 or 15 years. He's absolutely right. Headline inflation numbers are not accurate, folks. They don't reflect real world conditions, as we know. $1 in 1978 is now worth 20 cents. So that's, you're swimming just to stay above inflation. Other indicators suggesting economic weakness ahead. So I don't want to get too deep into the weeds here, but credit card and loan delinquencies are at their highest point in the decade, just from after the 2008, 2009 crash. The leading economic indicator is suggesting a recession, 21st straight month in a row with a month-over-month decline. So yeah, even the conference board says signaling underlying weakness, GDP growth to turn negative in Q2, risk of recession ahead, no signs of recovering at all, and continuing to signal recession. You can see here in the past when you have the LAI going negative like this, that gray area, it's a recession. It goes negative, another recession, goes negative. So we're kind of due, folks. And the stock market, is it that strong? Well, maybe if you're in 2 or 3 companies. Just the other day, look, 1.3% gain in the S&P. It was just 2 companies, Meta and Amazon. The largest breadth divergence since Black Monday. So, the Magnificent Seven is kind of the Magnificent Four of late, representing 75% of the year-to-date S&P return. So you're doing great if you're in those 4 stocks. I mean, let's be honest, but that's not really trading the stock market per se. Look at the difference here. This is the equal weight S&P 500, versus the S&P 500, that big divergence there. It wasn't until, gosh, mid-December that the equal weight S&P 500 was even positive for the whole year. So unless you're in those 4 or 5 big tech stocks, you're just you've been flat. I don't want to get into this, but you can see the money flow. It's all into the technology space here. So interesting. Here's moving averages on the 50-day moving average in terms of the percentage of the S&P stocks are below their 50-day moving average. It's dropping. We'll go back to that. So the amount of stocks in the S&P 500 is actually dropping. That is strengthening and getting above their 50-day moving average. This is interesting. Insiders over the last year. Look here now. This is the ratio for insider selling. So very interesting. The Russell 2000, 407 companies reported year-over-year growth is down 47% as of just yesterday. Anyway, I don't want to get too negative here, folks. I'm just, I'm not saying the end of the world, but be prepared. Not going to be up every day forever in the stock market. Probably facing a recession this year, and maybe beginning a late recovery, but later in the year. But job losses, so much of this is not reflected in the actual headline government numbers for various reasons. But we don't have to go into the weeds too much. But we'll get close to wrap it up and get a few questions here. We like the stock index futures, the E-minis. They're less volatile than a regular stock. Strategies for all directions. We can just look at 1 market, 2 markets, 3 markets. So just reviewing the benefits here. We don't stock pick. We don't have to always be up or down with our direction. We don't have to try to trade the chop necessarily. That's not what we're doing. We have that wide margin of error we talked about. Here's an example of 750 points between the calls you're selling and the puts you're selling. We think it can save you a lot of time using ThetaTrader. Here's one guy saying he spends 10 to 12 hours a day consumed by trading. Diversify, use an alternative approach where you're not always long. You don't have to be passively long and always bullish and buy everything. So that's what we like. Having a little bit of exposure to the alternatives, such as what we do. Kind of a portfolio that might look like that, using these automated option strategies. All right. So here we have the 5 steps you need. You complete that order form. You'll get your ThetaTrader login. You'll get an email on how to open your account with AltaVest. And once you've funded your account, you can begin trading. So it's just that simple. So you get the algo-driven options trades, strategies for bullish or bearish or non-directional situations. You'll get that trading simulator we talked about, kind of a time machine. Those alerts come right to your phone and your email and your desktop. one-touch responsive alerts. Here's an example of what it looks like on your dashboard. And then you would view the alert there and then just accept it or reject it. And of course, on your phone, you just touch your screen, and that's all you have to do. And that's what the form looks like here from with timing research, and expires Friday night. So let's see, I do have a few. Yeah, certainly you can trade this with your phone. You can accept those alerts on your phone. Absolutely. It's a responsive website as well. And yes, you need to have an account with AltaVest. Good question. Someone said, first time I understand option strategies. True, I watched many presentations. All right, well, good. And someone here said they were lost. Sorry about that, but call me or email me. Hopefully I can answer your questions. And what else is there? Someone said the California phone was cool. Yeah, anyway, okay. Someone missed the beginning. Yes, you need an account with AltaVest, and we've been doing this since 1997. Thanks for the compliment there. Good information. Yes, trading on the go, kind of go anywhere, trading on the go. Absolutely. It's sort of what we call low velocity. So you're not hyper, it's not a hyper velocity type of approach where you have to be in and out, in and out, in and out. A lot of these trades take a few weeks to mature and then close out. See a lot of new questions coming in. No, it's a lifetime membership. Lifetime membership. One time you pay and that's it. And then you have that 30-day guarantee on it. Someone like the charts, economic stats. Well, we'll see if that recession comes or not, but that's what the signals are right now. Lifetime membership. Let's see. Everyone's performance is different, so everyone uses ThetaTrader differently. Just like anyone at a brokerage firm will have different performance. Minimum account size. We suggest 25,000. Each Dragonfly is about 5,000 in margin. So if you had much less than that, you'd be very limited to maybe just 1, 2, or 3 Dragonflies at a time. So that's the reason for that. But let me know what you have in mind. Nothing's written in stone. It's just definitely a recommendation there. So I think I will wrap it up and give the next person a chance to get started here on time. And again, take a picture of the screen there, screen capture, and love to help you out and work with you. Been doing this a long time. That's my direct number and my email. And there's the link. So it does expire Friday, and hopefully we'll hear from you soon.